Hello and welcome to the Investor's Guide to Asia, where we bring you details of the most interesting stories from across the region. I'm Stuart Rumble, Head of Investment Directing at Asia Pacific for Fidelity International.
And my name's Taoxia Wang, Multi-Asset Portfolio Manager. On today's podcast, we will be talking about are Asia high-yield credits back on investors' radar again?
It's a really interesting question because it's not the largest part of the credit market. It's about 10% of the global high-yield universe. So that does mean it flies under the radar quite often. But we've had 3 years of very good returns. Year to date, up 8%. So it's a great time to be talking about Asia high yield.
Absolutely. And not everybody knows this, but this asset class has existed for decades. And its risk characteristics have really evolved over time.
Yeah, it's really important also to have that on the ground insights, isn't it? Often with high yield, upside is kind of capped by achieving your coupons, receiving your redemption proceeds, but the downside could be quite nasty. So you've got to be a real expert when it comes to investing in this field. And we're lucky to have two experts who are dedicated to the asset class and have been so for many years.
Joining us in the studio, we have Taeho Rui as well as Terence Peng. Terence, I'll start with you then. What do you think is the top misconception on Asia high yield credit now?
There has been quite a few misconceptions over the years, but if I have to pick one, it will have to be the concept that Asian high yield, it's all about China properties. Now, when we talk to clients and some of the market participants for that matter, they for right reason, I guess, in the past, but not so much anymore, they automatically associate the entire Asian high yield asset class with China property. That's not quite the case anymore because if we look at the underlying universe at this point of time, it's really about 5 to 6% of the entire universe versus previously it could be 1/3 of the entire asset class. So that shift has been tremendous and we have experienced it firsthand, but I'm not quite sure whether it's completely registered to the investor base.
I think it's a pretty significant shift. Even when it was just 30% of the overall market value, the ability for Chinese property to move the space is probably greater than 30% in terms of the actual volatility. Taeho, people often refer to high yield bonds as junk bonds due to the high perceived risks associated with the asset class. Do you think that's a fair characteristics?
I think the term I don't think is used as pervasively as it might have been in the past. I mean, people still throw that around, but obviously since the 1980s, the asset class of high yield credits in general has evolved and grown to the point where we are now that I think the investing into this asset class has won the acceptance from many investors. So really, when we look at credit markets, those that are rated BBB minus and above, we categorize as investment grade. And anything that's below, so starting from BB plus, we categorize them as, you mentioned junk bonds. We can also call them high yield bonds. I think, speculative has also been used quite often times. But really the point of investing in high yield bonds is to deliver a return that's greater than what you might be able to find in investment grade credits, where by default, by its very nature, you're not taking on as much credit risk and you're not exposed to as much of default risk. And therefore, you're not going to be getting paid as much. Now, come to the high yield. Obviously, you face all those risks that I just mentioned. As a professional high yield investor cannot avoid. It's really just a matter of managing your risk, which is oftentimes quite difficult to do if you are an individual investor and if you wanted to do it on your own, because diversifying of that risk as an individual is going to be quite difficult. So I think that's where people like us try to add value.
I suppose when we talk about default risk and the significant shifts we've obviously seen in Asia high yield, referring back again to China property, it's been a difficult space, obviously, the last sort of 3 or 4 years, but it's now a lot smaller. And I assume that's sort of changing the risk profile of the market. What's come in the place of China property? We've seen shrinkage there, but what's come in that space and how does it influence the risk characteristics of the index?
Yeah, I think if we're to take a step back as an active manager, of course, Teho and myself, we would like the universe to be more diversified as a principle, because that means there are many more levers that we can use, both from an idiosyncratic point of view and from a sector point of view, where we can actually move things around and make sure that we can deliver the alpha, the outperformance towards the universe. So what we have seen in China property, of course, has been a reduction in terms of the overall weight and the absolute amount of these issuers. But importantly, we have seen others coming in and basically take their place. Not just from a percentage point of view, we have ever seen quite a bit of new issuers actually from different industries. So if you look back, for example, like 5, 10 years ago, the likes of financials, consumer, and utilities, they are all below 10%. Now, if we look at the universe at this point of time, financials is close to 30% of the universe, and it comes from a variety of countries, including banks and non-bank financials as well. So we have seen new issuers coming in, and if you will, enriching the overall issuer spectrum. And it's the same case for the consumer side and for utilities. So now they are all at or around that 10% mark.
Great. So nicely diversified, and a lot of the issuers that have come in and taken up a greater share, the likes of India as issuers, providing attractive yields. We've also seen a spate of upgrades in recent years, and they've been important drivers of the good performance that I mentioned before. Teho, where are we in terms of performance today? What's sort of been the drivers year to date of returns?
So if we look at the past 3 years, depending on which index you look at, but the Asian high yield is probably up anywhere between 35, 37%. So what does that mean? That means annualized return of low teens, which when you think about the historical per annum return that you can get from equities, for example, it's been a very strong return of a period. I should also haste to add to those who may not be as familiar with this market that, of course, the asset class had gone through some very difficult periods of time in 21 and 22 in particular. There were a lot of factors to that. And so looking back, really the bottom of this asset class, this market was around November 22. So really not that far off from what eventually became the reopening of Chinese economy that many people got excited about at the onset of the start of 2023. I think the lesson is, when sentiment is quite bleak and, there's not a whole lot of money coming in, oftentimes that could actually be the opportunity. So in the case of high yield investing, we still need to get the issuers right, get the security selection right. And so long as we can do that, then the return will follow. And that's been, by and large, most of the times, the case for us and for the market for the last 2-3 years.
You talk about the market sort of bottoming out relatively late compared to other sort of risk assets and relatively close to this sort of current China recovery, revival in animal spirit. On a forward-looking basis, do you see this sort of improvement in sentiment, improvement in macroeconomic indicator continue to lift this asset class?
You're absolutely right. We're seeing some encouraging positive data come through. Some parts are a bit mixed still. Some parts still a bit slower. So, jury is still out there, in our opinion, as to how, consistent the general macro level of economic recovery will turn out to be. But our stance is, and what we can tell our investors is when you're investing in high yield market in general, but especially Asian high yield that we're responsible for, you don't need to lean so much on those macro levels of catalysts for you to be able to make money. Because again, the critical part is really boiling down to the bottom up and getting the company, getting the issuers right. And that's where you can make a big difference. And therefore, that's where Terrence and I we spend a lot of our time on speaking with the analysts and our colleagues just to make sure that we are doing as good of a job as we can to the front.
It's one of the things that fascinates me most about this asset class. And you do need a big team around you to help support doing the issue analysis, because often when times are good, that's when you get a lot of supply coming to market. So these are companies issuing, more choice for you as investors, which is great, but it might also be an indication of exuberance, and the vice versa. Things are bad, liquidity in the market dries up, it becomes equally tough. Terence, what's supply and demand like at the moment in Asia high yield? Is it supportive?
Yeah, generally speaking, we have seen quite a few years of negative net supply, and that is to say, the amount of redemptions and coupon far outweighs the amount of gross supply that we've seen in the market. So the quantum of that negative net supply has reduced over the past couple of years, but year to date, we are still looking at, roughly speaking, negative 50 billion for the Asian high yield universe. So we are still very much at that juncture where supply is smaller than demand.
So let's hit the third aspect of this. We've got reasonably good fundamentals. We've got a reasonably good supply demand picture. What are valuations telling us? Is it an opportunity at the moment, or is it time to be more cautious?
I think valuation is very tricky in the sense that it can give you a solid ground to form your own opinion about whether the market is seemingly attractive or not. But oftentimes, the valuation is not a timing indicator. It doesn't really tell you as to where the market is going to be in the next few quarters out, if not years. And so typically things like expensive things that you may not necessarily like because by certain objective quantifiable measures, they do stack out to be quite expensive. But that does not mean they will sell off next week. So whenever we talk about valuation, I think that's something we should really think harder as a start. Is it can give you a snapshot and it can give you a sense in terms of time series of, historically, which level are we now on? But again, it doesn't tell you what the future is going to be. We look at the Asian high yield now where the outright yields, depending on which index again, but it has now sort of dipped below 7%, still mid-high 6%, thereabout. Spreads probably about 300 plus minus. What does that mean? If we go back to the era of pre-COVID, in our opinion, that outright yield feels still quite attractive. Who knows what the Fed is going to do from here? There's a lot of expectation around further easing. We don't know again where the market rates will be 12 months from now. But historically speaking, high 6%, about 300 spread, one can argue is not a slam dunk in terms of the apparent attractiveness. But we would argue whether this will be an attractive potential total return for investors will depend on a number of things, including how the alternatives would have performed for the next 12 months. So if the equities go up another 10, 20 or more, then we wouldn't look as brilliant. But if the other asset classes did not perform as strongly, perhaps, then high 6, 7 sounds pretty solid to me.
I really like this nuanced view on valuation. How do you look at it on a yield basis, on a spread basis? How do you compare it on a cross asset class basis? How do you compare it across historical, etc.? And I think it's always important to remember that valuation shouldn't be viewed alone. It should be viewed together, for example, with the favorable technical. The joke goes, the best companies to lend to are the ones who don't want to borrow money from you. So I think all of these things should, give us a sort of a more multidimensional picture.
And for context, we should probably say as well that credit spread, which is that extra risk premium that you require when investing in credit over and above an equivalent risk-free government bond, for instance, at 300 basis points, is tight. I think it's at record tights, in fact. So we're not talking about particularly attractive levels versus history in terms of spread, but as Tejo said, in terms of yield, that 7% is a really nice cushion as a starting point. And of course, bond investors are very used to thinking about interest rates as a risk for high-grade bonds. Obviously, when rates go up, bond prices go down and vice versa. So they're an important driver of returns in high-quality bonds. But that's not so much the case with high-yield bonds, is it, Tejo? Can you explain why?
Yes. So if we look at purely the government bonds, I think you used risk-free, depending on which government. But let's, in the textbook context, classify the government bonds as indeed risk-free. Then when you invest into the govies, as a bond investor, your biggest risk factor is going to be the duration or the interest rate sensitivity, because that yield move up and down is going to lead to whether you're making money or losing money. The moment you come into credits, i.e., you are taking on some potential credit risk that arises from this issuer, then you're getting compensated via what we call credit spread. And of course, in the landscape of investment grade, that spread cushion is much less than in high yield. So typically, in a rates rising environment, for example, those investment grade credits may suffer as a result of that spread cushion being not as punchy. And oftentimes, largely because of the profile of those borrowers operating in investment grade market, I think Tausha said earlier, the best company does not need to borrow your money. They can also borrow on a longer term. So they can borrow for 10 years and beyond, no problem. And so therefore, as a bond investor, then you're exposed to much higher duration risk just by nature of that. And so I think those are some of the nuances when you invest into those sub-asset classes. Coming all the way to high yield, we mentioned earlier that this asset class duration is about 2 year plus. It's the lowest amongst major global credit indices. And so you're exposed to the least amount of interest rates sensitivity compared to other segments of the market. And besides, just between high yield and investment grade, yes, that spread cushion is fatter. Of course, that doesn't necessarily solve your problem when going gets really tough, because ultimately you are bearing the company's credit profile risk. So that needs to work out. So we will have to go back to our earlier point about making sure the security selection is done properly. But it will at least give you that buffer that when we think about the rates volatility, we're of the view that high yield is, again, a place where investors are less exposed and more immune, therefore, from the potential jittery that we might see in treasury yields and other government bond markets.
With all that in mind, I think it's a great time for us to turn to our Asia economist, Pei-Chen Liu. She will talk to us about our China macro outlook, as well as outlook for interest rate cuts in the region.
For China, I think it's quite evident that the first half was surprising on the upside. That's mainly attributing to two factors. Firstly, the front-loading of exports ahead of tariffs. And secondly, more importantly, the fiscal front-loading that stemmed from the trade-in program support. Durable goods were doing well. But over the last 2 months, we saw some marginal slowdown in terms of durable goods consumption and its contribution to retail sales. We also had some early signs of slowing down in the property sector as well. That also comes in with weather-related disruptions over the summer. So overall, I think macro picture is largely stabilizing but tilting towards the weakening part. I think going into the next few months, towards the end of the year, we do expect more fiscal or monetary policy to come up to support or offset some of the downside risks that's been stemming from the various consumer and property sector. But we expect manufacturing and exports to continue to do well, given that China has been diversifying its exports market over the last few years. But overall, I think in terms of macro drivers, we're looking more in terms of the long-term plans of China. We're waiting for the 15th five-year plan to be released in China to have a sense of where China is heading towards in the next 5 years. After the US-China trade truce, I think it reduces the urgency for the Chinese policymakers to come up with bigger and faster reaction of stimulus. But nonetheless, we think support is needed. And perhaps the policymaker will deliver that in a more targeted fashion that reduces the probability of rolling out additional fiscal easing like 2023 or 2024, but we still expect administrative policies as well as fiscal monetary policy to support stabilization in the next few quarters. For the rest of Asia, I think given the export front-loading has been a main driver of growth in the broader region, we do think there is a risk of payback in coming quarters when tariff kicks into effect. Therefore, we're watching closely the central bank reactions across the region to the potential slowdown of external demand.
That was our Asia economist, Pei Chen Liu, speaking to us earlier. Terence, Pei Chen touched on the topic of tariff again. We've heard a lot about tariff impact on, overall market. What about the specific impact on, Asia high-yield credit fundamentals?
Yes, that has been something that we have investigated quite a bit, actually even way before Liberation Day. Going back to the previous point about the asset classes more bottom-up driven, we tend to focus on what's the underlying impact to the specific issuers. And from that point of view, our assessment is it's actually relatively manageable versus the other global risk assets, be it equities or fixed income. The reason it's multifold, but if we think about the underlying risk reward from a credit investor, we are primarily thinking about credit spread risk and default risk. And if we look at the current universe, we have, first of all, quite a bit less cyclical or directly affected industries versus the other asset classes. For example, we don't really have autos, and except perhaps for one or two pharmaceutical companies or the frontier sovereigns, say for example, the general universe is very much domestically oriented. If we take a step back, at this point of time, what we are understanding just now from Taeho is the credit spread risk is actually quite a bit more limited because of the spread duration. So if we focus on default risk, at this point of time, we do think that from the bottom up feedback from our analysts, the overall universe is actually in a better place. Aside from perhaps a few well-telegraphed names or sector, we are actually witnessing a all-time lows in terms of the overall default rate year to date.
Did you mention earlier that financial is the largest sector, and is that a sector that you would characterize as relatively sort of domestic focused and therefore relatively immune from the tariff side of things?
We got this question from perhaps how European investors quite a bit in terms of, financials are quite big, it should be quite high beta, wouldn't that affect negatively the risk and reward of the universe? So perhaps a bit of a disambiguation here. In Asia, financials are actually the lower beta part of the universe. There are a number of reasons for that. Generally speaking, as you said, the financials, especially banks, they are much more domestically driven. And therefore, because of the fact that the Asian economies in general have more room to cut rates, and very much the financial systems are well contained domestically. That means from a system support point of view and from a potential write-off risk point of view, we very often see that as lower risk. And another point to understand is from a underlying ownership point of view, the Asian financials, especially banks versus the world, they have much higher share of issuers that are either government owned or government supported. And that means in a case where when things perhaps goes a bit wobbly, in the past we have seen the countries such as Korea and Japan preemptively supporting the financial institutions before perhaps they go to the brink or even to the point of non-viability. And therefore, from that point of view, the risk of permanent capital lost and therefore the associated beta of the financial sector, which is now close to 30% of the universe, is actually much less and therefore arguably much safer from an investor point of view than many of the global financials.
Definitely a very different story compared to the European cocoa story.
And Terence, you as a portfolio manager have a broader remit as well, encompassing managing a fund that invests flexibly across the different Asia bond markets. How does this compare across the region? Where are you seeing the opportunities and potentially the risks from a broader perspective?
Yeah, I think first of all, when we look at Asia, as all of us have talked about, as Pei Qian has talked about, the overall economic picture is slightly different. Foundationally, we have much better growth inflation mix because the inflation is more benign. And therefore, as a central bank in Asia, you actually would have more room, other things being equal, to cut rates to help the economy, which means from a downside protection point of view, you would want to invest in credit or fixed income in general in Asia because it provides you with that downside. And importantly, if you're investing in local currency bonds, you would be able to access and enjoy the rate cuts that provides you with the additional total return boost. I think another thing that it's quite apparent in the past few years, it's there's much more acceptance by the global investor arena by understanding that Asia and Asia Pacific, for that matter, it's now actually higher quality, and therefore it shouldn't be considered as, for example, part of a very risky spectrum. When you risk on, you pump your money into it, and when things wobble, you take your money out. We now see much more capital and investor view that this should be a structural allocation. And because of that, we see much stronger investor interest and demand, for example, in Asian high yield, broader Asian credit, and Asia fixed income, both across hard currency and local currency. And if that continues, that would help Asia as an investment region to be much more through the cycle and evergreen than it has ever been before.
And policy support and investor flows aren't just a credit story. We've seen investors re-engage with Chinese equities this year. To understand the drivers of the rally that we've seen so far, we caught up with Teresa Zhou to find out more.
The China market has been performing very well this year. I think there are a couple of the factors behind the market rally. Firstly, the starting point of the market has been quite attractive in valuation. At the beginning of the year, MSCI China was only trading at 10 times forward price to earnings at a historical low level and also at a discount to the emerging market. The second factor was about the policy direction. Since late of last year, we have seen the macro policy turn to be more supportive. That will help the China economy to stabilize. In fact, for the first half of this year, China's GDP grew by around 5.3%, which is better than expected. And the third factor I think, is liquidity. So the overall liquidity environment has been quite accommodative, leading to the increasing fund flow and improving investor sentiment. Externally, the Fed has started a rate cut cycle and the dollar was weakened. Both are positive for emerging markets, including China. Domestically, Chinese deposit rate is trending lower and housing price remained weak, which means there are less alternative asset options for both households and institutional investor, which make the equity become favored again. So that also leads to the increasing flow into the stock market. The last point is about the fundamental change and economic transition. While the overall economic growth remains relatively weak, but we have seen structural growth opportunities coming from innovation and manufacturing upgrade. In many sectors, there are structural growth opportunities. For example, in technology, we have seen the rising of Chinese own AI, large language models. If we look at the factors behind the China's rally, a couple of the factors will remain in place, including the favorable liquidity environment, supportive policy, as well as the structural technology innovation. But from here, because the valuation now becomes more reasonable with the MSCI China valuation now back to the historical median level, I think some of the positives are priced in and the market volatility could rise. So we do need the corporate earnings to catch up to sustain the rally from here. We do have the risk of the slowing down of economic growth into later of this year. That's why I think we need to be selective in stock picking and also be valuation disciplined from here.
So that was Teresa Zhou on Chinese equities. As Teresa alluded to there, the question I get asked a lot is just how durable this rally in Chinese equities is. And we've seen earnings improve, but only really in pockets. And we need that to broaden out for it to be a little bit more sustainable and potentially also see some additional policy support come through. So that's important. We want to look at progress on consumption policies, the new anti-involution policy, and obviously monetary easing as well. So it does pay still to be quite selective as well in Chinese equities, it seems.
But understandably, there are a lot of reasons for investors to get excited for Chinese equity. For example, the reignited animal spirit, a lot of the thematic growth opportunities around, technology, innovation, as well as still reasonable valuation. Started from being quite cheap, and now it's still, I would say, sort of mid-range historically. Linking back to our topic du jour, Asia high yield. How does this, improvement in investment sentiment in, almost like a neighbor asset class, China, Asia, equity, sort of what does it do for sentiment in the Asia high yield?
It does help, obviously, when the general investor sentiment for China and the region improves. So I think that's certainly helpful. It's really depending on how you look at it in relation to the alternatives. In our opinion, it is still quite decent enough, certainly to stay invested at least. Ultimately, fundamentals will drive and prevail. So, the short-term euphoria or pessimism that we have seen both signs of over the course of last few years, we're likely continue to see that take place because this is financial markets. People's emotions will come into play, but ultimately the fundamentals will help determine the performance of the investments. So I think that's where it really helps to take a much longer term stance.
So we've talked a lot about Asian high yield performance, market structure, fundamentals and valuations. Terence, what are the major risks that we have to look out for in the coming quarters?
When we think about risk, the number one risk naturally would there be single name risks that is big enough to affect the entire universe? It can either be because certain names that are more highly leveraged or fundamentally weak drive a bigger downturn of the entire universe, or it might be because the underlying earnings and the leverage profile of the universe, which is quite healthy at this point of time, catches down to regional macro. So that would be certainly number one risk. Number two, and that's something that we have seen before and alluded to previously by Taeho and myself, it's sentiment comes and goes. So when we see, generally speaking, quite depressed investor sentiment, that spillover effect would inevitably affect Asian high yield as well. But at that point, we would say there are two things that investors should remember. First of all, the lower spread duration and the interest rate sensitivity means if you are worried about a lot of capital downside in other asset class because of interest rates, because of spread widening, it would not necessarily be the case in Asian high yield, which is a corollary of saying that if you have witnessed a big change in terms of the underlying spread or yield, it might actually be a buying opportunity, as we have seen time and time in the past. The second part, perhaps to understand it, if we have this asset class that gives you actually quite handsome yields from an all-in yield point of view and not a lot of capital downside, you would want that to be in reverse part of your capital allocation in a more, perhaps a bit more safety kind of allocation, dare I say. So most people tend to associate high yield as, oh, when there is some kind of risk of event, the first things you want to get out within the fixed income allocation is high yield. Not necessarily quite the case for Asian high yield, as long as you believe the underlying issuers and the overall universe is going to stand high, and that is our assessment at the moment.
So where do you see the best opportunities now?
We tend to make sure that instead of making calls of, oh, we like a certain country or we like a certain industry, we focus on certain single names. And we are definitely seeing names that we believe still has opportunities. And say, for example, this year, we have seen 3 risen star from the rating agency's point of view. And we are investors of those names. And as we see the traversal of names from high yield to investment grade, naturally we see the bonds being repriced, the underlying risk reward change quite a bit. And importantly, in order for us to access the best opportunity, you have to be forward looking. So after a name, in our opinion anyways, after a name becomes investment grade, most of that risk reward would already have been captured. And I guess to take a step back to your point, which parts of the universe that we see the most opportunity, I think we want to make an argument that the entire universe actually is quite attractive. And a lot of clients tend to ask us, why do we want to invest in Asian high yield? Almost in the sense of, previously to Taeho's point, we have to choose between, we're buying Asian high yield or US treasuries or whatnot. It doesn't quite work like Asian high yield because of all the things that we've talked about. The correlation is actually pretty low. So if you look at 10-year correlation, it's only 0.2 versus US treasuries and 0.4 versus US equity. So for everything that you already have in your portfolio, having something that has good risk reward and not correlated with your allocation that is already there, I think for us means the entire asset class should be considered quite attractive.
Terence, Taeho, I think that was a nice place to end the conversation. It's been fascinating. For me, it's certainly clear that the Asia high yield universe has evolved into a much broader and more balanced market to invest in, but income is clearly still very, very important. But also that credit spreads are tight relative to history, so it's really important to focus on issuer selection.
Yeah, definitely. I think Asia high yield is an asset class with rich history, with evolving characteristics. It is definitely a very valid source of income for investors, especially if they're looking for something a little bit less correlated with a lot of the other asset classes. But bottom-up selection is absolutely important where you try to, steer clear from individual default or blow-up risk.
So that's all we have time for this month. Thank you, Taeho Rio, Terence Pang, Peichen Liu, and Teresa Zhao.
You can find out more from this topic from your local Fidelity website as well as fidelityinternational.com. If you enjoyed this episode, please share and subscribe.
The producers today were Holly Eastman, Dan Tam, with support from Patrick Graham, Judy Chen, Tommy Sue, Keith Chuen, and the managing editor was Seb Morton Clark. For now, from me and all of us here at Fidelity, goodbye.